So how do you quickly and effectively improve your credit score, particularly your FICO score, since 90% or more of lenders use FICO in their scoring models when assessing you for an application? Well, one of the most important and effective ways to improve your credit score is to break down how the credit score is calculated and attack that improvement through segments, those different segments and calculations. We're going to cover one of those in this video called credit mix. Basically, the diversity of your credit. We're going to explain what it is, how it's calculated into your FICO score, and how you can maximize it to push your score through the roof and have a sturdy credit profile in this video. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, proper use of life insurance, and the ownership of real estate. Like this video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity. So in this video, we're going to quickly cover what credit mix is, how it's calculated, how it's impacted by your score, how lenders are looking over it and how they view it, and how you can maximize it. Your credit mix is, as I said in the intro, it's your diversity of your credit profile. Some of you may either be new to building credit, or you may be rebuilding your credit and never really had a solid foundation on how your credit score was calculated and how it works to build it up. One of the reasonable calculations within your credit or FICO file or your FICO credit score is credit mix. The diversity in accounts you have, meaning the different types of credit accounts that you have, primary trade lines on your profile. You can have revolving, which breaks out into multiple different segments. Everything from credit cards, gas cards, store cards, home equity line of credit, personal lines of credit. You have installment loans. This is going to be broken down into multiple segments as well. Auto loans, home loans, personal loans, unsecured loans, secure loans. The list goes on. It breaks out, as you can see, into many different subsections that make up your credit mix. And having an understanding of this is important, because there are some people out there, some of you out there with phenomenal credit scores, prime credit scores, 720, 740 and up, that have weak credit profiles because you don't understand credit mix and diversity. Credit mix usually makes up about 10% of your score on FICO scoring models. There are other scoring models and there's other companies like Vantage that put their scoring models out, and these things can be a little different. Generally speaking, about 10% of your score is coming from credit mix. And to be honest with you, it's a heavy 10%. And what I mean by that is lenders look at this pretty closely in the underwriting department. It may not come up a lot in conversation. There's not a lot of financial content out there around this, but lenders look at this very heavy, especially depending on what you're applying for. So if you're, and I'm going to cover this in a more extensive video, but if you're looking for certain larger scale or higher profile loans, auto, home loans, they're going to want to see, or even high limit credit cards, prime credit cards. They're going to look into your credit mix to see if you've handled anything like that before, or at least a sub version of it before. So basically, if you're going for a home loan or you're going for an auto loan and you've never had any type of installment loan on your credit report, this could be damaging towards your application. So you understand what it is a little better. You understand that it's about 10% of your credit score, and you have an idea of how lenders are looking at it, right? They're looking at it to see if whatever you're asking me for, you've managed some version of it before. It's pretty common sense when you think about it in that capacity. Now you need to understand how to maximize it, because you got to be responsible. Those of you who are starting fresh or starting over, or if you're on track but you're just trying to scale up further, you have to understand that it's not a good idea to necessarily go out and just apply for a bunch of different type of credits now that you understand this credit mix calculation. You have to be strategic. You have to look at your credit profile, see what is missing, and manage how to scale up from that point on. You may have a revolving credit line, heavy credit report, meaning that you have a bunch of credit cards or, some variation of store cards and gas cards, things of that nature, but have little to no installment loans. Then now you want to continue to scale your revolving credit report outside of your credit report. But now you know that you need to focus on and work hard on incrementally developing your installment loan side. Now, the caveat to diversifying your credit mix is you cannot or should not apply for a bunch of credit at one time. You opening multiple different credit accounts, even when it looks simplified to you, you might get multiple different credit accounts from one lender, and your financial profile may be very sensible in the process, but lenders can only see, generally speaking, that one part of your financial profile is your credit report. If they look on there and you're applying for credit with them and you've applied for and got approved or got about 3, 4, 5, 6, 7 new accounts at one time on your credit report on a really short, recent period of time, this is alarming and a little nerve-wracking to lenders. They're going to look at you and say, this person has a high likelihood of being cash strapped. Why are they going out and applying for so much credit? Now, mind you, those of you who are on this financial journey to financial excellence and, leveraging credit to acquire assets, we know that you're out there applying for all these different credit lines and loans because you're trying to boost up your credit, strengthen it so you can go out and use that liquidity to go out and grab assets. But lenders don't think that way, unfortunately. They haven't caught up to this world. So what they're going to do when they see this is get nervous. And that means they're either going to approve you at a lower limit or they're not going to approve you at all because you look risky. And remember, all lenders need to feel comfortable and secure in their borrowers. They need to have confidence. So with that being the case, you have to be strategic. You want to keep in mind that about 2 to 3 new accounts is about a max for about a 6-month period. 3 to 6 months. Inquiries, which we're going to shoot a more detailed video on, are on your report, and they're a major part of what lenders look at when they're also looking if you're desperate for credit. Because even if you didn't get approved for these accounts, but you have multiple inquiries in a short window of time, this can be nerve-wracking for them as well, because it just means you're trying to get a bunch of credit and you just haven't gotten your hands on it. It still makes them nervous. Those last on your report for 2 years, but FICO scores typically only gauge them for about 12 months or calculate them in for 12 months. So that's important to know. We'll shoot another video on that soon. So what's the key ingredient here? 2 to 3 new accounts, maybe 4, or if you really want to be strategic, scaling out across credit profiles, meaning that a lender is only going to usually pull 1 to 2 bureaus at a time, and being strategic in adding new accounts based on which bureau they pull their credit reports from. And that way you can work on a bureau at a time and let those new accounts come on at similar times or identical times, and let those inquiries come on at similar or identical times. Age together and fall off together. This is referred to in the financial space nowadays as gardening. We'll shoot a video around that as well. But anyway, you understand more about what credit mix is. You understand how it's calculated, why it's so important to lenders, how they look at it, how to be careful going about developing it, and why you need to have as much of it as possible, how to go about getting it. 2 to 3 new accounts every 3 to 6 months is reasonable. Depending on that, it might be more sensitive than that, 6 to 12 months. Be careful depending on what your future borrowing plans are, because some loan types and lenders are more sensitive to new accounts and new inquiries than others. So do your homework. But I wanted you to understand this so I can bring value to you around developing or redeveloping your credit score and a sturdy credit profile, because some of you have strong credit scores that are fragile as hell because you don't have enough data and diversity to prop up those scores. Any little thing can drop your score because you only have 2 or 3 legs that it's standing on. So keep that in mind. We're going to talk more about this and break this out into a series, but I wanted to bring credit mix because it's an underspoken about calculation in your FICO scores that are very important. I know this was valuable for you. Thank you for tuning in. As always, I want you to stay focused, stay in motion. I'll see y'all soon.